Dividends are a portion of a company's profit that a shareholder can receive. The more shares an investor holds, the larger the portion of the profit the company will distribute to the shareholder. However, purchasing only dividend-paying stocks with the aim of generating a stable cash flow is one of the most common mistakes made by investors. Let's imagine we have two ETF funds that track the same index and have the same fees. One of them pays dividends and the other does not. What does this mean for an investor? If you receive dividends and reinvest them, your financial result will be no different from an investor who holds a fund without dividends and reinvests the profit within the fund. Why is this so? If you hold an ETF that pays dividends and use those dividends to buy more shares of the same fund, while another investor holds an ETF that does not pay dividends and does nothing, your results will be nearly identical. Of course, taxes and costs should be considered, but overall, your strategy of reinvesting dividends and the strategy of holding non-dividend paying shares will lead to the same financial result. Let's consider an example. Suppose the assets of our funds amount to $10 billion each. If your fund pays dividends, its capital decreases by the amount of these payments, and the value of its shares falls. If my fund does not pay dividends, its capital remains unchanged, and the value of its shares does not change. As a result, you will have more shares, but each will be cheaper than mine. This means that dividends and their reinvestment do not create additional value. They merely redistribute the existing capital. From an economic perspective, it does not matter whether you receive income from stock growth or dividends. The main thing is the risk and the absolute level of your portfolio's return. Suppose you invest in non-dividend paying stocks and sell a portion of them to generate passive income. If the value of the stocks grows faster than you sell them, your portfolio will continue to grow. Imagine you start by selling a small number of shares each year. If the value of the shares grows by 6% annually, and you sell only 4%, your shares will never run out, and you will have a stable passive income. In practice, this means that even if stocks do not pay dividends, you can create income by selling part of them. Economists Miller and Modigliani proved in the mid-20th century that dividend payments do not affect the value of a company. This means that you can generate income by selling part of your shares just as you would by receiving dividends. Their work confirms that, in terms of total return, it does not matter whether you receive dividends or sell shares to create income. Buying only dividend-paying stocks to generate a stable cash flow is a mistake. If a company directs $10 million to dividend payments, that company decreases in value by $10 million. Money does not come from nowhere, and the value of a dividend-paying stock decreases after the ex-dividend date. Thus, if you hold dividend-paying stocks and receive 4% in dividends annually, while I hold shares of a company with the same financial metrics, but without dividends, my shares will grow slightly more than yours over the year. Research has shown that value stocks generally yield higher returns compared to growth stocks because they are associated with greater risks. However, using dividends as an indicator of value stocks is not advisable. It's better to use direct indicators such as the price to book, PB ratio, rather than dividend yield. Consider an example. If a company's shares are worth $100 and pay a $2 dividend, then their value drops to $50. But the dividends remain the same. The dividend yield increases. This does not mean that the company has become better. It just means its shares have become riskier. Focusing on such secondary indicators as dividends is not always rational. Investors should consider only risk and expected return. The source of income, dividends or capital gains, does not matter. If passive income is needed, you can sell part of the growing stocks. If dividends are needed, you can reinvest them. Combining both approaches will provide higher returns with lower risks due to diversification. Let's imagine two funds. One brings 2% in dividends and 5% from growth, while the other brings 7% from growth without dividends. If the risk of these funds is the same, both will suit you. You can reinvest dividends or sell part of the shares to create income. Combining these two approaches will reduce risks through diversification and increase your overall return. Our favorite investment companies, such as Vanguard, have also conducted research on dividends. They have shown that dividend strategies are better considered in terms of total return. The highest returns come from stocks with both high and low dividends, so it is important to diversify your portfolio rather than concentrate on one type of stock. Economists Eugene Fama and Ken French have repeatedly emphasized that dividends should not matter to an investor. They explain that using dividend strategies is often associated with psychological factors and can lead to insufficient diversification and increased risks. Dividend stocks are often purchased due to the illusion of stability and real income, but in reality, they do not offer any advantages compared to non-dividend paying stocks. It is better to focus on the absolute level of profits and risks, rather than on dividends. This is confirmed by both scientific research and the recommendations of major investment companies. If you want to build your initial capital but feel that you lack financial literacy and knowledge of investment strategies, I suggest you subscribe to my channel and write the word investments in the comments. I will send you a detailed guide on investments and an effective strategy with 3 ways to invest your money so that it generates passive income for you throughout your life, all for free. The money will truly start accumulating in your accounts, and you will have more of it. Check it out. Write investments in the comments and start learning.